In the joint venture, institutions always want the right, and they should, because they need to respond to their investors that if you are screwing up the deal, then they can fire you. And then your equity in the deal and your growth will get locked in.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Sam Sells came back on the show here today with us. If you hadn't caught Sam before, he was on episode 690, which is going to be actually pretty here recently. That was on October 20th of 2022. We covered some awesome stuff about his backstory. But today we're actually going to cover kind of part two, working with institutional partners. And this is going to be what we focus on here today. So Sam, thanks again for coming back on the show. I certainly appreciate it. And again, as probably before, love your first name. So welcome back.
Yeah, thanks, Sam. And by the way, we have the two best moms in the world who named us Sam. I mean, it's just, how can you deny?
No idea, but I certainly am grateful, and I think we actually, we're of a similar age. I would imagine Sam was not a popular name. I guess I was born in '81. There weren't many of me around back then.
No, yeah, I was born in '79, so we're both 25,
Right. 25 in heart, my friend, 25 in heart.
Yeah.
I'm looking forward to this conversation today. In talking about working with institutional partners and or larger check writers, things along those lines is kind of that next level, I think, for most syndicators, most capital raisers. Most of us, myself included in this, have no idea how to do that. I raise money from all my friends, from colleagues, from family, from people, obviously listen to the show. I've never worked with institutional partners. So I get to ask you legitimate questions as to how it's done. How do you even start working with institutional partners?
Yeah, great question. Look, I look at syndication and commercial real estate, and I really look at like 5 major levels of success, right? And we learn how to raise money, we learn how to operate on our own, and then we learn how to put that together, raising money for our own deals, and then we go into the next level is to work with institutional partners. Now, there's levels after that, but institutional partners for syndication is like, hey, XYZ company, are you interested in this deal? I need $20 million. And they're going to say, great, you have 10%. So do you have $2 million? Like, yep, I got $2 million in cash. It's our own cash. They're like, great, we'll do the other 18. We love this deal. You work it out. You do a joint venture agreement. You sign. They deliver $18 million, and you do your $2 million. Now, that institution is funded through a fund. They're either insurance company, or they're like life insurance or car insurance or health insurance. They have these massive amount of money. They got to do something with it. Pension funds. So you're a teacher, your money's going into a pension fund. Pension funds invest in real estate a lot because real estate is just so much better than stocks, and they need to have a reliable source of income, not put all our money on red, spin the dial, and hope it works out. So that's why they come to real estate operators. Now, these big funds, they don't want to do the work. Right. They want somebody else to do the work. And so they need a commercial real estate operator to do the work. Now, that is somebody who's going to be responsible for the asset management, responsible for the property management. They may not necessarily have to have PM in-house, but they need to have a great working relationship with one. It actually helps if you have PM in-house with a lot of institutions. Some institutions say, no, we want it always to be a third party because it's easier to fire them and hire somebody else. It just depends on the institution, but these institutions have large amounts of cash. So if you're a syndicator or even an operator, you want to go to the next level where you want to buy $100 million deal and you need a $30 million check, it's easiest to go to an institution and get that from one person. Now, the institution has requirements and things that you've got to be able to do. And so if you've never done this yourself, the best thing to do is to hire a mentor I started helping people make that transition into working with institutions because we've been down that road. And what I did was I hired an institutional guy to come into our company, and he helped us build out and close our first deal with an institution. And then he stayed on with us.
Wow.
And he does institutional debt and equity. So all of a sudden we went from raising money from our friends and everybody else to doing institutions. Sorry, that's a lot of words.
No, that's absolutely great. I'm really curious. One, how do you find the institutions? And then, and you alluded to this where you talked about the criteria for the sponsor. I mean, again, what are those things that you're going to have to, what is the personal development side of things as a sponsor that you have to be in order for an institution to even look at you? I mean, I feel like many people, especially as they're kind of just getting their feet under them, getting traction, they're not going to have the boxes checked off where a sponsor's going to, or institutional partner's going to say, yeah, I want to work with you.
Right. So you need to go down that path, right? And you may never want to work with an institution. You may only want to work with retail capital just because of how things are set up and how the cash flow works. When you close an institution, it's a cash negative event. Okay, so you're going to get an acquisition fee, but you're looking at like a 1% or 1.5% acquisition fee, unless you can talk your institutional partners into more. You need 10% of the capital minimum. 10 to 20% is normal. So like I said, if you need $10 million check, you need $1 million of your own cash. Can't be any other investor's cash. It has to be your own cash. Now, some of the pros, what they do is they set up a new company. They put in a couple of partners that bring cash to the table. And then that company links with the institutions and do that. That's a pro tip. Through that management company that's set up with a partnership, et cetera. So that's kind of how you can get around that a little bit, as long as the institutions are cool with that. But there's definitely systems and set criteria that you need to make and reach. And it's really not as unattainable as you may think. If you're in the military, you're familiar with MEPS. It's kind of like going through MEPS. You're sitting around waiting, and then you get every orifice of your body checked. They're going to go do incredible amount of due diligence. They're going to listen to your podcast. And our partners are like, Sam, I heard you on this one podcast and you said this. Tell me more about that. I was like, oh, okay. That's crazy. But they want to know who you are inside and out because they know they're partnering with you, and the deal may be a 10-year hold.
Right.
A 20-year hold. So they really want to know who you are.
Yeah. So vetting the sponsor is, vetting you as the sponsor. Obviously, they're gonna do a deep dive on you, which I think is the one thing that I tell everybody who's a passive investor. Anyway, it's like you're vetting your sponsor. I mean, that's 80% of the work. So
that's 80. Yeah, that's it. Like real estate's the real estate, and the market's gonna determine a lot of it. And if your sponsor isn't responsive and changing out PM companies or leading the property management company to do a better job, or, reading the tea leaves and doing this or that, or they were dumb and paid way too much for the property going in because fear of missing out or whatever, and they have a high basis, then you're in trouble. It's all about that base.
Absolutely. How do you find, I know you brought somebody on your team to kind of, bridge that gap initially, but how would you recommend somebody find institutional sponsors / larger check writers, such as, what we're talking about here?
Yeah. So 2 ways. One, easy, just reach out to me. And if you're already operating, you've got a bunch of exits and you've got a ton of assets under management, I'll just connect you with, we'll just get you connected with equity and help you close your deal. And we can do that on a fee basis, like we would do with any other person, but as an equity broker, and using those relationships. If you've never done that, you've only got, let's say, $20 million of assets or $5 million of assets, and you're like, Sam, help me get on a trajectory so that one day I can make one phone call and connect a $20 million check, because I don't want to go do the tap dance and raise money all day long, right?
There is that, and I think that's one of the greatest attractions to having an institutional partner is that, man, it's one call, one check. This is a lot simpler than, I say, raising capital, which I love talking to investors. I love raising money, but it is hurting cats. I mean,
it is hurting cats, and and you can't please everybody all the time, and somebody will be like, hey, you're 2 days late. I'm like, life, that's all my house. I'm sorry. I've got other things going on.
I hate to say it, that I'm guilty of it too, as a limited partner in other deals, because there's no, as a passive investor, there's not the pressure that you feel. You can't convey that pressure to a limited partner. It's like, hey, for me, it's like, man, I'm busy. I got deals I'm working on. Yes, I'm going to invest 50 grand or 100 grand in your deal, but I got to take care of this first before I can get to the bank and wire and crud them 2 days. Like you said, I'm 2 days late. Their problem is not necessarily mine. And that's not a good attitude to have for a guy that's raising capital, but it's just reality.
It's just reality. We're still humans. We still got lives. We still got kids and family, or, we still got things to do. Right.
And if we can get guys like me out of our life and somebody else says, okay, this is a single check. Tell me about, I mean, that's some of the attractive parts. What are some downsides maybe to working with larger institutions?
Yeah. So with that one check, there's a big stick, right? And in the joint venture, institutions always want the right, and they should, because they need to respond to their investors that if you are screwing up the deal, then they can fire you. And then your equity in the deal and your growth will get locked in at that point. And so you'll still be an owner, but you're essentially moving from the sponsor role to an LP role. So you'll still make money off the deal. But for example, on the project we have with an institutional partner, we put in about $500,000 of our own cash, and we'll make about $7 million over the course of 10 years coming out. Now, I think we'll make a lot more than that because we're we're over a year ahead of our projections for value and revenues and occupancy and everything else. We're just killing it, and our partners are super happy with us. Even in a bad market like it's getting out there, we're still doing fantastic. But our base is really low. We bought well, and our partners and us get along really well. And so it's that relationship becomes extremely key. And so if they want to meet twice a week, you're going to meet twice a week with them. But they're professionals, and they got all these guys hired from Harvard and Yale and Stanford and, Cornell or whatever. And these guys have studied, and they're a lot of times they're very, very book smart about all this stuff, but they've never done on the ground work. And so you do have to do a little bit of education, like, hey, I know, we need to do this, but, with the sewer breaks under the ground and it costs $8,000 to repair it, I can't do anything about that other than get it done as quick as possible.
Right. Yeah, absolutely. When should someone in their capital raising, syndicating, investing journey, when should they begin starting to think about, okay, now it's time to start looking for institutional partners?
So you can start from the beginning of your career as an operator. So I look at, like, when you begin, you should really probably start on the capital raising side because properties have become so expensive. And that way you can get into much bigger deals. So you go from being a capital raiser, learning how to build that foundation, to operating your own properties. Now that you've worked with other operators who have done it really well or bad, and you've learned from them, and now you become an operator. And once you become an operator, I'm retired Air Force guy. I always taught my troops, like, trajectory matters. What do you want to be in your life? If you want to be a chief, fantastic. Let's set a trajectory for you to make chief. If you want to become an officer and whatever, then let's get you on a trajectory to do that. And so as an operator, start at the beginning and say, someday I just want to work with single check writers, and I want to own $1 billion worth of assets, and I want to buy those over the course of 5 years. Great. You can do that without building a massive capital raising machine. Go that way. It's a different path, right? Or you want to do both, which is what we do now. We raise private money and we do, institutional cash, and those we reserve different deals for different groups based off what we know their requirements are and what they're looking for.
Do you, on those different deals for different groups, I know it's kind of a left turn in the conversation, but is that the only criteria, is that you know that some groups are looking for this and some groups are looking for that? Or is there more that goes into deciding who you shop these deals out to?
Yeah, it's also capability, like our own capability to raise money. Like if we know we can only raise $5 million because our network is relatively small, then we'll do deals with, our private citizens that are up to $5 million of capital raise, right? But I know if I'm going to the institution, 5 million is the smallest an institution's going to do. They want bigger checks, because if you think about it, they have $1 billion on their hands and they've got to place that, and they want good deals. And so they're calling us or asking for deals all the time. And we're like, I've only got the small deal because this is the only one I can find that can pencil.
Right. Yeah. They don't, I guess, what is that? If they have $1 billion to spend, 5 million at a time, that's what, 200 deals?
Yeah. That's a lot of deals, right?
He wants to be involved in 200 deals, 5 million at a time. That's a lot of people.
I don't. Oh. Yeah, as an operator, you're like, you're out of your mind. Give me 5.
That's for sure. That's for sure. What is, and I guess that's the next question, is that when it gets to those bigger deals, $50, $100 million deals, it gets very competitive because there's a lot of big institutional capital chasing those deals. Are you even finding ways to underwrite and make those pencil today?
We haven't. So we found really around $30 million, between $15 and $30 million is where we've been able to get things to pencil more often than outside of that. One, because the competition is less, and two, because we're small enough that we still want to make money. We're not in it just to close deals. And you'll meet plenty of institutions that are like, our cash needs to go somewhere. Right. Because 4% return, 6% return is better than 0 and negative. And they will not put it in the stock market because that's just dumb. And so I say that because to ultra wealthy, that's dumb. Regular citizens, it's the thing to do because that's what everyone tells you to do. Because the institutions make the most money when you do that. And then they invest your money into real estate, by the way. That's how that cycle works. Anyhow, so they're willing to pick up a $100 million deal with not very much meat on the bone. And they'll call it a value add deal because you can increase the rents by $10.
Right.
Great. So just buy it, jack up rents, don't add any value, and make a little bit extra return. If the market goes sour, they're still better off because they're going to hold up for 30 years, and who cares?
Right. Yeah. And so that's, I guess, the answer to the question, which is, are you finding those larger deals? And you answered it when you said 15 to 30 million is kind of where you guys are finding, which is still, if you're getting 20 or 30% leverage on that, you're still raising, $9 to 12 million bucks a deal, depending on what your CapEx plan is. Is that a range when you start getting over into double digits? Is that when you can start talking to institutions, or does it need to be bigger than that?
Yeah. So 10 million, you'll find a lot of institutions that'll do $10 million checks.
Okay.
You'll need $1 million of your own capital, or form a management company with that much in cash in the bank ready to get deployed, and then find a really good deal. And we can help do that. And there's others that know how to do this. There's not a lot, particularly in the syndication space. I've given presentations to others on this is how you do this, and people had no idea, right? So when you syndicate, you put your 50K in, and you're really on the GP side. And if you got 5 sponsors, by the time it all whittles down, you're going to make some money on the deal. It's just you're not going to be that much. You're really doing it for experience, and so you can keep doing it. And maybe you're doing it for the acquisition fee. It's the opposite way around. When you deal with the institution, you're going to make a ton of money doing what you really want to do, but it's going to be a negative cash transaction at the beginning. So you're not going to make money on the close. You're going to make money on the hold.
Right. Which is not that any of us should be doing any deals to make money on the close. I mean, certainly I think that's icing on the cake. And for us, it covers expenses. It puts a little bit in our pocket maybe, but it's something where, buying for the cash flow should be what we're doing anyway.
Yeah, it should, but you're right. Look, every deal we do, we'll have hundreds of thousands of dollars by the time we close a deal, just in due diligence, earnest money at risk. My staff doing all the work. So I don't feel bad at all about our, acquisition fees, because that pays real people, real dollars. And so when we do institutional deals, I have to have that money, and we just eat it until we get paid, down the road. And so you have to be in that ready position. The interesting thing too is your attention to detail on these large deals is with them is higher because they expect more, and they can't expect more, and they're going to hold you accountable to it. And so you just need to be ready to perform. And if you're ready to perform, like we have been and are, it's worked out really, really well. But if you're thinking you're just going to turn it over to a property management firm and wait for your updates that you can send out to your investors and hope all goes well,
this is not for you. It doesn't.
It's not for you. Right?
What has it done for your business? Like how has this changed the trajectory of your company in bringing on institutional partners, and what should someone else expect if they really follow the plan you've set forth?
It's changed everything. So it put us on a different trajectory that I didn't know existed for the longest time. Okay. It put us on a trajectory to, obtain $1 billion worth of real estate. And for us, value add real estate, it's heavy lift. We need really good, strong partners. And we do try and want deals to go out to retail investors, friends, family, people that we know, people that we get to know. But we also want to have the capability of doing very large operations, because the economies of scale are just so much better. You can hire more staff, you can hire the best, you can, so on and so forth. So it just puts you on a different trajectory. Doing both answers the question of, I need cash flow up front to fund my team to do the work they need to do. And we want to, make a huge difference on a huge property. And so by doing both, we can do both. Ultimately, though, you want to become one of those funds. That's, the next level is where you hire, as an institution, you hire other operators, and you get to sit back and your asset managers do the work, and you just come to work and sign stuff and then go back to the ED.
I love it. I love it. Sam, this has been incredibly insightful. Thank you for taking the time to break down how you guys have found opportunity and how you guys have worked with institutional partners to give us some really practical advice and just some how-to on this. I certainly have learned a lot today because, again, this is something I know absolutely nothing about. So thank you for taking the time to educate me and also our listeners. I certainly appreciate it. Here, the second time having you on the show. If our listeners do want to get in touch with you, learn more about you, what is the best way to do that?
Yeah, reach out to me via email, sam@wildmountaincapital.com. You can go to our website, wildmountaincapital.com here. And if by the time this is broadcast, you could probably go to syndicationlaunch.com, which is our new learning platform. It is in the early stages. So if it's ugly, yell at me and say, Sam, this is ugly, or it needs this. I'm happy to fix it. We are working on that because we really have learned that not very many people know how to do these other aspects. And we're happy to help and teach because partnerships make everything better.
That's awesome. Sam, thank you again. Certainly appreciate it. You have a great rest of your day.
Thank you, Sam. Always a pleasure.